Hi, my name is Linda Eedes, and I'm a senior member of the Regarding Capital Management, or RECM, investment team. Today I'm going to be talking to you about the RECM Flexible Equity Fund. Now, this is a fund which is a South African equity fund, and it's benchmarked against the All Share Index. The fund follows the exact same value philosophy as all our other funds at the firm, namely that we only ever invest in stocks when we believe that they are trading substantially below what we calculate them to be worth. And we try to stay away from those stocks which are expensive or trading well above what they're worth. Now, looking at the returns for this fund over the recent past, you can see that the fund is represented by the maroon line and the index is represented by the grey line. And this shows its history since inception. You can see that recently the fund has actually lagged its index quite substantially, but there's a very good reason for this, and it comes down to our investment philosophy. As I mentioned, we follow a value philosophy. The reason we do that is we have conviction that that is the best way to generate superior long-term returns for your investors, as well as protecting against the risk of permanent capital loss. Now, in order to do that, you need to find the stocks which are very cheap in the market and stay away from the stocks that are very expensive. So let's look at equity valuations in the market today. Looking at this graph, what we show here is the price to book multiple versus the long-term average for each of the sectors within the All Share. Now, the All Share is represented by the black line, but you have the resources sector in green, the industrial sector in red, and the financial sector in blue. And you can see that the index which is trading today substantially above its long-term average is in fact the industrial sector. The sector which looks very cheap looking at this metric is in fact the resources sector, the index in green. Now, it should come as no surprise, given our philosophy, that we would be focusing on investments in the resources sector and staying away from those expensive stocks, which may be very popular in the industrial sector, but represent the risk of permanent capital loss when those prices adjust to more realistic levels. And you can see, interestingly, that in 2007, 2008, it was quite the opposite. So at the time, the resources index was in fact trading at all-time highs, and the other indexes were a lot cheaper. Now, the flexible equity fund had very little resources exposure at that time. And in the short term, that didn't look to be such a good decision. And in fact, the fund was again lagging its benchmark quite substantially over the recent history. However, when the market fell, some of those resources stocks fell by more than 65%. And all of a sudden, the philosophy and the benefit thereof came into play. And the fund not only protected capital during that market environment, but also was able to grow investors' capital substantially by taking advantage of those cheap opportunities when they presented themselves. Today, we have the opposite, where the resources represent value, and many of the stocks which we invested in after the financial crisis in industrials have now become expensive, forcing us to sell out of those stocks. Let's take a look at the breakdown of the portfolio in terms of the asset composition as well as the top 10 holdings. Looking at the pie chart, you can see that the majority of the fund is invested in local equities and a small position in preference shares as well as local listed property. We do still have an 11% position in cash, which every single day we're looking to deploy into the market in undervalued opportunities. Taking a look at the top 10 holdings, you can see many of those themes echoed in our top 10 stocks. So resources exposure features strongly, names such as Anglo American, and the three biggest platinum producers, Anglo American Platinum, Implats, and Lonmin. Now, I just want to touch very briefly on our investment into the platinum sector. The thing that differentiates those three platinum producers from many other platinum producers in the market is that those three platinum producers supply more than 3/4 of the global platinum supply and sit on more than 90% of the reserves for the globe. Now, that represents a very permanent barrier to entry for those three miners, because what it means is that the cost pressures that they face, the labor issues that they face, affect the entire global platinum supply curve. So anything that affects the platinum price or the marginal cost of production for those producers will ultimately work its way through into the platinum price as the supply and demand dynamics of the market normalize. Other themes which come through in the portfolio are gaming and leisure. You can see HCI is there, Sun International is there. We also have investments in Soho Sun as well as Grand Parade investments. Now, up until very recently, that industry was at a cyclical low, and the market didn't like it very much as a result. Revenue numbers were, of course, very depressed relative to what you would expect through the cycle. The share prices have come up a bit since then, but still today represent value. Looking at the fund as a whole, we believe that the Flexible Equity Fund represents excellent value today. And in fact, we're very excited about the opportunities we're seeing in the South African equity market. However, if you want to take advantage of those opportunities, it means you have to go against the crowd. And that can be uncomfortable in the short term when you look to be wrong, as prices of stocks which are undervalued go down even further, and the prices of those stocks which you're staying away from, which are expensive, become yet even more expensive. But there is a very good reason for that. And we know that by sticking to the value philosophy, we're best able to protect our investors' capital against the risk of permanent capital loss, and to really position them for the best opportunities with regards to the potential to generate superior long-term returns over time.